This week in AI, two companies that were already worth hundreds of billions of dollars decided that wasn't enough. I'm Joshua. Let's get into it. On May 4th, OpenAI and Anthropic both launched enterprise AI joint ventures on the same day. Combined, the two deals represent roughly $14 billion in new capital committed, and the move signals something important. The AI race has officially shifted from building better models to deploying them at scale inside real businesses. Let's start with OpenAI. It announced a new venture called the Deployment Company, which raised more than $4 billion from 19 investors at a $10 billion valuation. Named backers include TPG, Brookfield Asset Management, Advent International, and Bain Capital. OpenAI itself put in $500 million up front. Notably, the deal offered investors a guaranteed 17.5% annual return over 5 years, which is an unusually structured commitment for a company that is not yet public. That guaranteed return tells you something. OpenAI is desperate to get its models inside enterprises fast, and it is willing to pay Wall Street to make that happen. Anthropic's venture is smaller in scale, but no less significant. It raised $1.5 billion with founding partners Blackstone, Hellman, and Friedman, and Goldman Sachs, each committing roughly $300 million, and Goldman Sachs putting in about $150 million. Additional investors include Apollo Global Management, General Atlantic, GIC, Leonard Green, and Sequoia Capital. The plan is to embed Anthropic engineers inside portfolio companies of those investors and rebuild day to day workflows around Claude, starting with healthcare and mid market industrial companies. Both ventures borrow the same playbook from Palantir. It is called the Forward Deployed Engineer Model. Engineers from the AI lab embed inside the customer organization for weeks or months, sitting beside clinicians, claims adjusters, supply chain planners, or finance analysts, and building workflows that actually fit the business. That is the opposite of shipping a software product and walking away. The impetus for both companies is the same bottleneck. Marc Nachmann, global head of asset and wealth management at Goldman Sachs, put it plainly in an interview with CNBC. He said there is a big shortage of people who know how to apply these tools into businesses and then transform them. Anthropic Chief Financial Officer Krishna echoed the same concern, saying enterprise demand for Claude is significantly outpacing any single delivery model. Think about what that means. The models exist, the demand is enormous. The thing standing in the way is people who can actually do the integration work, and both companies have decided the only way to solve that is to build their own services arms and fund them with some of the biggest private equity firms in the world. What makes this especially notable is the timing. Both companies chose the same day, essentially carving up the enterprise market into two camps with overlapping but distinct investor bases. Rather than competing head to head, they are running parallel plays through different financial intermediaries. It is a partition of a market before the market fully forms. The implication for the rest of the tech industry is significant. Traditional consulting firms and system integrators like Accenture and Deloitte now face two well funded, model first competitors who can offer AI native workflows as part of the deal, backed by the research labs that are already setting the benchmark for what these models can do. That is the wrap. Sources in the description. I'm Joshua. Catch you next week.